Hey, everybody, welcome. Today, I want to talk a little bit about what types of businesses should you think about buying. If you're thinking about acquiring a business, what type of business should you think about acquiring? And there's a few different things that I like to look at when I'm doing this. The very first is to think about a business that's profitable. You have a choice of whether you're going to buy a business that's not making money or that's breaking even or that's actually making money. And the truth is it's just as easy to find profitable businesses as it is to find businesses that are having trouble. So rather than having to acquire a business that you're going to have to turn around or even go find even more cash to put in outside and above the acquisition price, I think the very first thing I'm going to look for is the business actually making money? The second thing would be to think about there are two types of businesses and there are two types of multiples. Businesses typically sell for a multiple of the profit that they make. And so we have two kinds of businesses that create different types of multiples. One is a business that's owner operated, meaning that the person that is running it is the person that owns it. If that person was to go away, then the business would likely not continue. And that's most businesses, I would say. The majority of businesses are owner operated. Somebody founded it. They're wearing all the hats. They are the CEO. They are the person that does the work. They're the person that keeps everything up, all of that kind of stuff. And in those owner operated businesses, we go with a multiple of the profit that's called SDE. And SDE stands for seller discretionary earnings. So seller discretionary earnings is basically the operating profit of the business, the gross income minus the expenses. But then we add back to that the expenses that the owner is putting in that are owner benefit that aren't necessary to actually operate the business. So an example of that. What about the owner that has their car paid for by the business, or the owner that has their personal computer paid for by the business, or their trip that they take? Maybe it's a family trip and they write that off on the business. These are all fairly common things that are at least quasi-justifiable, and so they're not necessarily bad in terms of the company books are messed up in a bad way, but they do tend to deflate the profitability of the business because they overinflate or they overstate expenses with expenses that you don't actually have to pay. If somebody comes to buy that business, they don't need to pay for the trip. They don't need to have the car paid for, and they don't need to have their computer bought from there. They might choose to, but so what we do is we add the back to the income, the things that are the owner benefits. So those expenses the owner's taking over and above. That would also include sometimes the owners might be paying themselves more as a salary than it would cost to hire a professional manager and put that person in. So that'd be like if the owner's paying themselves $200,000 a year, but we could find a manager for $80,000, then there'd be $120,000 that would go back onto the profit for determining what is SDE. Now, SDE is owner operated with professionally managed businesses, meaning that the owner can leave for any amount of time and the business is going to continue to do fine. Those are professionally managed businesses, and we use a different statement of profit to calculate multiples to determine what's the valuation of a business like that. For those businesses, we use a term called Ebitda, and that's basically an acronym of the initials EBIT, D, and A, which stands for earnings before interest, taxes, depreciation, and amortization. So why do we have this fancy thing called EBITDA? Why don't we just call it profit? Well, when we determine what the actual, from an accounting standpoint, what the net income, that's what accountants call the profit of a business, is, we're going to take out expenses for interest that might even be related to the acquisition itself, or they might be related to capital equipment or capital expenditures for assets that aren't necessary. Like you have to have them to run the business, but it's not really fair to include those in operating margin because they're not typical operating expenses. They're acquisition expenses, right, of capital assets, assets that we're going to ultimately depreciate. So the interest on those we take out, and we add it back to profitability. That's why it's earnings before. That's interest. Then earnings before interest, the next one is taxes. The reason that we add taxes back is, again, taxes are paid and determined based on where the business is located, and they aren't really related to the actual operation of the business. They are a legitimate expense of the business, but they don't really tell us what the operating profit is. So we add taxes back. So now I've got earnings before interest, taxes, and then the next two, depreciation and amortization, we add back those because in the accounting world, there is a concept that says that when we acquire an asset for our company and it's got a useful life of a certain period of years, it's going to wear out eventually, and we're going to have to replace it. So it's good for us to have some sort of artificial mechanism for allocating the cost of the asset we're going to acquire, like maybe it's a piece of machinery or a manufacturing equipment or something like that, and to allocate that expense, not in the year that we buy it, because then it would artificially overinflate expenses by a whole lot. We'd have very erratic profitability if we did that. So what the accountants have decided to do, and they're able to do this for tax purposes too, is to depreciate, meaning to say there's a useful life for that asset, and we're going to take a deduction equal to the value or the cost of the asset divided by the number of years of its useful life. So an asset that cost $100,000, we would divide it by 10 if it had a useful life of 10 years, and every year there'd be a deduction or an expense for $100,000. Excuse me, what did I say? It was $100,000. So it would be a deduction for $10,000 per year, $100,000 cost of over 10 years, and we add that back for Ebitda, earnings before interest, taxes, depreciation, and amortization, so that we can see again what is the actual operating profit of the business. We're kind of looking almost not quite at cash flow of the business, but we're trying to get a real sincere look at what does it cost to run this business and how profitable is it outside of these unusual things. And then the last thing, amortization, the in Ebitda, is the same thing as depreciation, only it's for intangible assets. So tangible assets are things that you can actually touch in the physical world, and intangible assets are things that you cannot. So that would include goodwill when you buy a business, or it would include things like patents or copyrights, trademarks, brand. Those kinds of things are all considered intangible assets. And instead of depreciating those, we amortize those. And it's the same idea, because the truth is there isn't really a useful life of one of those. You could say a patent lasts for this many years or copyright lasts for this many years, but there's artificial terms that the accountants and the tax people have agreed on that you can expense those assets over. So we add that amortization back. So now we end up with a multiple that relates to the actual operating profit of the company, earnings before interest, taxes, depreciation, and amortization. So all of that goes to profitability, and then that goes to valuation, because most of the time, for convenience, there's like hundreds of ways to value businesses, but the most common way in the real world that people do it is using some multiple of the profit. And so if it's an owner-operated business, we're going to use SDE, seller discretionary earnings. If it is a professionally managed business, we're going to use Ebitda. Now, there are all kinds of resources for finding out where are these valuations. Like how do we find out what the valuation of the business should be? And there's a couple ways to do it. The easy way would be to go out and use a paid service, and there are several of those. There's Business Valuation Resources, or BVR, has a whole bunch of comparable companies. So they basically go out, they look and see what did companies like this sell for, similar companies in similar geographic territories with similar amounts of revenue and profit in a similar industry. What did they sell for? And then they'll aggregate those together and average them out and say, okay, well, on average, they sold for this much money divided by their Ebitda, their profitability, and so that equals the multiple that we're going to use to value other businesses. And that's a pretty good guide, right? So that's one that I would recommend that you think about using above other more complicated things. So where do you find these multiples? Well, One of the easiest ways is to just Google. So if I was looking to find the multiple for a digital marketing agency, let's say, then I would just go to Google and I would type in sales multiple for digital marketing agency. And then I'd probably do Ebitda multiple for digital marketing agency and a couple other things. You have to go through a few pages to find the current ones. You could also put in the year after that if you want. And very often you'll find one, or you'll find a resource that's a couple years old, and then you can go and reach out to the people that created that resource and say, hey, do you have any updated numbers? Because usually they do. Trade associations are another great place to go and find out what the multiples are. So if there is a digital marketer trade association, then I would go and I would talk to the people there and say, hey, do you guys have any information about what these kinds of businesses sell for? So that's the kind of inexpensive way to go about it. The next way would be to use, like I said, BVR or one of those companies that creates comparables. And then the last way, which I find to be pretty helpful, is the New York University, NYU Stern School of Business releases every year business valuation multiples. And so you can go there and download that from them. It's free. And then there are other companies that provide that kind of information as well, and you can just Google that. But that's what I do, and I find it very, very helpful to have an idea of what a type of business is going for. Now, if it is, let's say that it is just a digital marketing company. Well, if it's just a digital marketing company, then you're probably good with the multiple that you find. But maybe it's a more integrated, or a more diversified business. And part of the business is a digital marketing agency, part of it is a publishing company, and maybe part of it is an e-commerce company. Well, each of those three different types of companies are going to have different valuations. So the question is, how can I find out the value of my company if I've got more than one type of business in it? Well, you could basically take the expenses and the revenues for each of those three profit centers and calculate the Ebitda or the SDE for each of those three, and then use the multiple for each of those three different types of business based on that portion of the profitability. So let's say that you've got a business and it's a third digital marketing, a third a third publishing, and a third e-commerce. Well, and let's say that it's equal profit for each of those. It's $500,000 of profit for each of those, total of $1.5 million for the business. Well, then we would basically say, okay, 500,000, 1/3 of that total profitability of $1.5 million times the multiple for a digital marketing agency. Let's say that's 5. So that'd be $2.5 million. And then 5 times an e-commerce company. And let's say that multiple is a 10. So that'd be 500,000 profit, 1/3 of 1.5 million times 10, right? That'd be 5 million. So that'd be 5 million for the e-commerce section and 2.5 million for the digital marketing section. We'd add those two together and we'd have 7.5. And then we'd go to the last one, which is publishing. And let's say publishing is 1, and that's 500,000. So we've got 7.5 for the others. We'd have 500,000, 1/3 of the 1.5 million total profit, times a 1 multiple for publishing. It's usually pretty low, so that'd only be 500,000. We'd add that to the others, which were 7.5, and we get a total value for the company of 8 million. So that would be a way to come up with a valuation for a company when you've got different things going on. Now, here's what's cool. The last part of what I want to talk about today is how can you reposition different parts of the company so that they tend towards the higher multiple? Because that 1.5 million of profitability that we've got, remember, we had 3 different multiples. If we steered everything towards publishing and call it a publishing company, then it's going to be a multiple of 1. So we're going to sell that business for 1.5 million total profit times a multiple of 1. That means it's going to sell for 1.5 million. But remember that the digital marketing agency, we said, was a multiple of 5. So a multiple of 5 is going to be 7.5 million, right? It's going to be 1.5 million times 5 instead of times 1. So we're going to get let's see, what was it? 1.5 million for the the lower one, we're going to get $6 million more for the company, right? $6 million more just because we slanted everything towards digital marketing. And then last but not least, if we could get the whole 1.5 million focused on e-commerce valuation, which we said was 10, that'd be a $15 million valuation. So it's literally 10 times more for the same company if we can position it as an e-commerce company as opposed to a digital marketing company, as opposed to a publishing company. So we want to think about that. Now, you can't just slap a label on that company and say, it's all e-commerce. But you can really start to focus the efforts of the company so that the digital marketing component and the publishing component go to support the e-commerce component. And then when those do all get integrated, they will be considered most likely the multiple that you're looking for. So that's really some very important steps to think about when you're thinking about buying a business. And I hope that helps.